Good afternoon, everyone. My name is Alvin Adjei, and I am an attorney at the BA law firm. I am president of the Houston Young Lawyers Association, and we have our second event for the year for the small firm and solos. I'm very excited to be able to have this presentation. We have two great speakers who have been fortunate enough to give us some great information in regarding to getting a line of credit for small firms and for solos. Very important aspect. So I run my own small business and wanted to make that a big part of the focus for my year as president. And so fortunate to be able to have two great speakers to help us talk about something that isn't talked about a lot, which is line of credit. So I first want to introduce Michael Paul. He is in depending on your screen, but he's the one in the corner with glasses and the chase. Michael Paul is a business relationship manager for JP Morgan Chase. In his role, he helps businesses in revenue between 1 million and 20 million with their banking relationship. This includes deposit account services, cash management services, and lending solutions. Michael is a graduate of Houston Baptist University and has been in banking for 33 years. His banking career included two other banks, a small town bank in rural Texas and a startup bank in Houston. The roles in the bank include document prep, consumer compliance, audit, IT, and lending. He is a proud father of two and enjoys the arts, volunteering, and poker. We have Mr. Richard Rojas. He's the Senior Vice President of Allegiance Bank, and he is a proud Cougar, attended the University of Houston. He's originally from Illinois, and we'll forgive him for that small thing. And he is now, he's been in Texas since he was 5 years old. He's been in banking for over 22 years, and he's passionate about helping business owners with managing cash and managing growth. And he takes pride in being a trusted advisor for all of his clients. And so with introductions out of the way, we'll go into our questioning. So first is, what is a line of credit? And I'll have Richard give the first question.
Oh, absolutely. Welcome, guys. Thank you for the intro, Alvin. I'm excited to be part of this event this morning or afternoon. So we'll jump right in. So what is a business line of credit? So it's a revolving loan or line that allows access to a fixed amount of capital, right? Typically, it's used for short-term business needs. Rule of thumb on that is usually you don't want to draw from the line for any expenses or purchases that will take you longer than 12 months to pay back. So what are some examples, for you to draw from a line of credit? Typically would be, for payroll, marketing, supplies, inventory, things of that nature. Short-term purchases.
And then Michael, do you have anything you want to add?
Richard did a great job of explaining it. I think of it like a credit card that you want to borrow potentially to pay back immediately before the end of the month, or at worst case scenario for a short time because you're paying a high interest rate. So as Richard mentioned, it's designed for short-term working capital needs, whether it's for case to catch up on payroll, waiting on somebody to send you money that hasn't paid you yet, but you know it's coming, but you have expenses to take care of. So you want to draw on this compared to a credit card. A credit card generally is a much higher rate. Lines of credit are cheaper and is designed for short term. So if you're buying something that is going to give you benefit for a longer time, buying a company, buying equipment, buying a location, those are used, those you would have to have a term loan for, whereas a line of credit is for short-term working capital needs.
And I also want to remind the attendees that there is CLE credit for attending this event, and in the chat is the CLE number that you need to add in order to get credit for your attendance today. All right, so Michael, the second question, we'll start off with you. Why should a small business owner consider getting a line of credit?
There are different reasons. Obviously, one of the considerations is not to have pull money from your own pocket, from your personal funds to fund the business that you're using, leveraging the business itself rather than having to pull money from your personal resources. A line of credit versus a credit card would be the interest rate. Lines of credit generally are cheaper than a credit card, which may be in the high teens or in the 20s from an interest rate perspective. Also, in terms of building credit for a long term, if you're planning on growing your business and thinking that leveraging debt may be part of the plan, whether it's now or down the road, you're starting to build credit from a credit bureau perspective on the business side also. And you're going through the exercise of debt from a bank, which when you start requiring documents, you get a sense of what is required down the road in preparation for the future.
Yeah, that's great. The next question is, this one's for Richard. How is a line of credit different from a small business administration loan?
So absolutely, great question. So there are two different types of lines of credit. So a conventional line of credit, typically the requirements for that for us here at Allegiance Bank is you have to be in business at least for at least 3 years, right? A conventional loan is typically going to have a better rate than an SBA loan, but SBA loans are good for shortfalls in collateral, right? When you don't have any collateral to pledge, there is a SBA guarantee. Typically, it's like 50%. So that's the difference. I mean, if you're looking for a startup line of credit, the best route to go typically is SBA route. Now here at Allegiance Bank, we don't offer any essentially startup SBA lines of credits. I know the larger financial institutions, obviously, Chase, they offer those type of products. But again, I like to think of conventional as once you've been established for at least 3 years, and the SBA Express, essentially when you've been in business, I believe it's 1 year or longer, you've got both options. So that's the difference there.
And then I think just as a follow-up question for that one is, are the interest rates fixed? Are they variable? And what are the advantages of getting an SBA loan versus getting a line of credit?
Yeah, so in terms of the rates, good question. I mean, they're always going to be variable. It's very similar, like Michael Paul mentioned earlier. It's like a credit card. I mean, it's going to be a variable rate, right? So it's tied to Wall Street, the Wall Street Journal. So it's prime. Prime's at 3.25 right now. So when prime moves, obviously your interest rate is going to move. Typically we like to price ours, at somewhere in the neighborhood of about 4.75 to 5%, anywhere from prime. Again, prime is 3.25 up to about 1.50 or plus 1.75. So that's a range in terms of what your rate would look like. So again, the advantages of a conventional, typically, I mean, you're going to have it's going to be a better rate, right, than the SBA. I know when you go the SBA route, there is a guarantee fee, though those are costs that you got to incur obviously out of pocket to be able to establish that, because we do have the backing of the SBA in the event that the line were to default. So again, it depends on where you are in terms of your business model, whether it's more beneficial for you to go the conventional line of credit or the SBA line of credit. So again, there's not a one size fits all. It solely depends on where that particular individual and or business is at, in terms of the their business at that time.
And then what documents are required in order to do the application for either a conventional loan, an SBA loan, or a line of credit?
It's very standard in the industry. I mean, we typically require 3 years of business tax returns, 3 years of personal tax returns, personal financial statement, and then your most recent balance sheet would be, financial statements, balance sheet, and then profit and loss statement. That's enough to get us in the, preliminary to get it to underwriting. Typically, that's what we're going to require right out of the gate.
And about how long is it for the approval process?
So the beauty of working with a community bank, we've got a decentralized business model. So in terms of up to $1 million, it just requires my signature and my boss, right? So we can turn those around. We like to compete with speed to market. I can, as long as I have all documents in hand, all necessary financial information, I can get you an answer in less than a week. We don't send anything because we're the largest community bank in Houston. Everything's done here locally. We don't send anything to, Chicago or Michigan or anything like that. It's all done here locally. See, we compete with speed. We can turn it around and get you an answer pretty quick.
This question's from Michael. Well, what factors should someone consider before applying for a line of credit?
Good question. I'm going to tie this to the previous question because Chase looks at things slightly differently, even though there's a lot of similarities. And Richard will probably agree with some of this. So when you come to Chase or to Allegiance, say, here's my need, then we will kind of figure out whether to use the SBA enhancement. And just like Richard mentioned, one of the biggest reasons that we use an SBA guarantee is it's a shortfall of collateral. Another part is there's a change of ownership, or for other types of loans, for term loans, if there's a cash flow shortfall that we're trying to make up by going long on the term. So that is the way Chase looks at SBA, which is not, if I'm not mistaken, not much different from Allegiance look. So we will help you determine whether to go the SBA route or not. There is a fee involved with SBA debt that goes directly to the SBA. That is a consideration. So, and also the SBA line of credit, I think, caps out at $350. Beyond that, you have to go conventional. And as Richard said, they are all, any kind of line of credit is is a variable rate. We do loans, I think, up to 500 based on prime, and over that we tie to LIBOR or what are the new interest rate structure comes out to be. So we slight differences there, but very similar approaches to the way we look at the solution and tying our product to what is needed. From a documentation perspective, we will look at financials. Chase, up to $100,000, the collateral need is not as important. We will definitely take a lane on business assets. Even if there's a shortfall, we may be able to get past it. We look at only business financials up to 250, and over 250 we start looking at personal. Smaller lines, we might do it just 1 year's tax return, make it very easy for our clients. If they're profitable from a 1 year perspective, we might be able to set up a line. A slight difference from the way we look at a line of credit on a conventional, up to a certain dollar figure, and I want to say it's 250 and maybe 500, is that our conventional loan will do a 5-year revolving period where you can draw up and down for 5 years, and then whatever the balance is at the end of 5 years, Chase just terms it out over the next 5 years. So it's a 10-year loan with documentation only up front. You don't have to continue to bring us financials. The SBA product is slightly different, and Richard, correct me if I'm wrong, I think it's 4 and 3, 4 years of revolving and 3 payout, or the other way around. I can't remember the exact order. And again, we'll only use the SBA enhancement if it works out from a cash flow perspective, but we can't get there in terms of collateral, then we'll use the SBA enhancement to kind of shore up our, lower our risk profile. So from a rate perspective between the two, we actually look at, like, if we have every bank is required to build and grade a loan from a risk perspective. So if this client is a risk, let's say A, was the right client with risk B, we'll give the better rate to the person with the rate A. So if we bring that risk down by using the SBA, then they will also benefit from a better rate. So we will, our pricing structure is a comprehensive structure that looks at the risk profile of the client, looks at the collateral, looks at our relationship with the client, and builds a profile based on builds a risk profile and a pricing profile based on overall relationship and a risk and the risk to the bank from that particular product itself. I hope I answered the question.
Yes, you did. Thank you. Richard, this question's for you. So lawyers are typically high wage earners, but they carry a great deal of student loan debt. Are there programs that are specific to lawyers? And if so, what are they?
Yeah, I know. A very good question. I mean, here at Allegiance Bank, I mean, unfortunately, we don't have anything that's tailor specific to, you know, to professionals, i.e. attorneys. I'm going to have to revert back to Michael. I know Chase and some of the larger institutions, they got programs specifically geared to professionals, i.e. attorneys. So I'll turn it over to you, Michael, if you're able to explain maybe different ways in terms of being able to help the young attorneys that are just getting started, ways you may be able to help them. Here, I mean, we're going to require at least 3 years of being in business. So with that, I'll turn it over to you, Michael.
We don't have a specific programs, just like Richard mentioned, or Allegiance. We definitely recognize, just like Allegiance, we look at a cash flow from a global perspective for a smaller client. So we recognize there's debt, but if you're high wage earners and you're reducing debts, that's great. But if you're going out and spending it on the latest boat or the latest thing, and you're not accumulating cash, we can't give you credit for your personal strength, because it's you're not building liquidity. You're spending it on the latest truck or the or a toy that increases our risk. So we do recognize attorneys and other professionals, just like Richard would do, as a low risk in general, but we also have to look at specific client and build a profile based on that client.
So I guess it brings me to my next question then is, so, and it's for both of you, but I'll start with you, Michael. So what recommendations do you have for a small business that does not qualify for a line of credit?
I think our answers are going to be very similar. We definitely look at the personal credit. That is very important to us. We don't have a number that we look for, but we look at the credit report, and we want to make sure that you are paying your debt back. You know, that goes to the character of our client. Then the other part is the cash flow of the business. I have friends, just like all of us do, that have cash-based businesses that hide income. Makes it very difficult for a banker to lend if you're hiding income. You know, be truthful in your income. The quality of financials is something that I'm sure Richard and I are talk about every day to our clients. We rely on CPA prepared or tax return financials as financials. We rely on them. So the quality that you provide us is going to be paramount in our credit decision. We're going to look for cash flow from the business. Even if you pull it out into the personal, we're going to look at on the personal side. Global cash flow is an important factor, and your personal credit. We recommend for somebody new to start off potentially with a credit card if they don't have financials yet. Start, because those don't require financials generally for the smaller credit cards, and you can start building business credit while at the same time. So that's and it's an access for to get points back, or to start building. Take small steps in the process.
Absolutely. So what I would add to that is, I mean, the first question I ask is, why don't they qualify? Is it, credit challenges, too much debt? They haven't been in business for, for at least 2 to 3 years based on their scenario. I'd advise them on eventually how to become bankable, but you're exactly right, Michael, whether it's establishing a credit card, a gas card. I mean, the main thing is you want to start, somewhere to start building that credit history. So you're exactly right. I mean, the main thing is just get started building credit wherever you can.
And then, is there a situation where a small business qualifies for a line of credit, but you would advise they not do it?
For me, I mean, that would be more of a personal point of view, depending on their current debt situation. Again, I go back to there's not a one size fits all. I typically encourage business owners to set up a line of credit, whether you need it or not. I mean, they're always good to have in terms of having a peace of mind, right? What I've seen in my experience is I'll offer a line of credit to a business owner at a particular, time, and they qualify and they respectively, decline it. And then something happens in their business or, their cash flow cycle. Then they come back to me, and unfortunately at that time, they don't qualify, right? Whether they lost a customer, they lost there was a change of ownership, so again, I typically, if you qualify, I highly encourage you to set up a line of credit, and you're only going to pay, interest on the amount you got borrowed against the line. So let's say the line of credit is 100,000, very similar to a credit card, and you've got 20,000 that you've drawn off the line. You're only going to pay interest on the 20,000 that you've got drawn, not on the total 100,000. So I mean, they're good to have in the case of emergency. And as your business grows, obviously your needs are going to change. And at that point, we can go back to the drawing board and increase that line to help you with cash flow, depending on what stages your business model is at that point in time.
And then I'll direct this question to you, Richard, as well. So you both have spoken about or you hinted at there's a difference between a commercial bank and a community bank. So just for our listeners, can you let us know what is the difference between a community bank and a commercial bank?
Absolutely. So Allegiance Bank, I mean, we're the largest community bank here in Houston. We are a full service financial institution. We offer all the bells and whistles that the larger institutions offer. However, we distinguish ourselves with the level of service. And what I mean by that, I personally am on a cell phone basis with all my clients. They're welcome to call me anytime, whether it's early, late, or on the weekends. We're small enough to give that undivided attention to all our clients, but we're large enough to be able to give that tailored, specific solution advice, to that business owner and or that consumer. So that's the difference. I mean, we are the largest community bank, but we pride ourselves on the level of service.
And then Michael, is there anything you want to add to that?
In general, that's a fair statement, Richard. I've worked for small banks, as you mentioned in my bio, and I worked for, now work for JP Morgan Chase, the big one in the room, right? So commercial banks or larger banks, and the word is a misnomer. I don't know whether it's a good way to separate the two, because we obviously we have the same type of clients. So how does a large bank, the Chase, the BFAs, the Wells compared to an Allegiance, which is a Houston-based, a great bank, and nothing negative to say about them. The difference may be in two things. One is that we are specialists, so all I do is business lending. I don't do mortgages. I don't do personal credit cards. So I'm a specialist in the business, and I work with my partners that do the other solutions. The other part is that because Chase is so big, we handle everything out of the room. If you're looking for a treasury solution, it's our solution. Merchant services is ours. Our credit card is ours. we don't work with third parties because we are able to kind of have it all under one umbrella. So that's one of the two of the differentiating factors. And I'm not saying one is better than the other. I love Allegiance people. There are things that I can't do that I call over to Allegiance. And there's things that Allegiance can't do that they call over to her. So we look at each other's as, hey, yes, we compete with each other, but at the same time, we recognize what Allegiance or a community bank brings to the table compared to what a Chase would bring to the table. We might like certain industries and comfortable and be maybe liberal in lending to them, whereas Allegiance may have a completely opposite view of that, and vice versa. So one quick thing, Alvin, before you go to the next subject.
Yeah.
Whether you should have a line of credit, I'm with Richard on this one. I think of a line of credit a lot of times like having a spare tire. You never want to use it, but if you need it, it's there, and it's a great solution. If you looked at 2020, if you had not set up a line of credit ahead of time and you ran into collateral shortfalls, whether as an attorney or any other kind of business, while we're able to qualify you, that was the time to have the line set up in place, ready to go. So when that need happens, you're able to fund it without having to scramble at that point.
So I think that brings me to my next question then. So, because it sounds like you're saying that for a line of credit, it's almost like a security blanket that you want to use sparingly. So businesses, when they start, they go off and grow at different rates. When should a small business begin looking at securing a line of credit from a commercial bank, for example?
We want generally at least 2 years of operation before we start lending to any company. So you got to be in operation your entity needs to be in operation for 2 years generally before we look at lending to it. Otherwise, it'll be too new for us. So as soon as you hit 2 years, start talking to your banker. Hey, is a good time. Obviously, we're looking for profitability for the last financial that we look at. And it also kind of depends. If you're a solo practice, you're looking at just yourself, right? If you're a larger practice, then we're looking at financials for the firm as a whole. So whenever it starts hitting 2 years, you definitely want to start having this conversation.
And then, Richard, I guess same question for you. When should a business begin looking at securing a line of credit from a community bank?
No, absolutely. So exactly what Michael said. The only difference with us is actually we look for at least 3 years of you being in existence, right? So once you hit that 3-year mark, definitely come to us, and we can advise you on what we're able to get done for you. So no different than what Chase is doing, except with the exception of you got to be in business at least 3 years for us to consider setting up a line of credit.
And then I guess I'll direct this question to Richard. So how will securing a line of credit affect my ability to secure a mortgage for a house?
So good question. It depends on the line of credit is in your personal name or your business name. If it's in your personal name, then we're going to look at your debt to income ratio, since it's going to be reflected on your personal credit report. But if it's in your business name, it's reported to the commercial credit reporting agencies and not your personal credit. However, you still have to qualify from a credit score standpoint, debt service coverage ratio. So you'd have to look at your personal situation, and that's what we're here to help you with. We just want to make sure that you're not overextended in your current credit facilities.
So if I'm hearing you correctly, so if the line of credit is in the business name, it should not affect your personal qualifications for, it wouldn't be counted against you in your debt to income ratio whenever you're applying for a house.
That is correct.
And then I guess the same question, and maybe this is the same answer. How will securing a line of credit affect my student loans if I decide to refinance my student loans? I'll direct it to Michael.
We are not in the student loan business, but I don't think it should. It should be separate. The business entity everything under that stays under the business. We don't report, just like Richard mentioned, we don't report our business debt or business credit on the cards on the personal credit report. So it should hopefully not affect you in any way.
Yeah, we don't offer student loans here either.
And then in regards to the and then I guess and I guess for the opinion for both of you, when do you see businesses get in trouble when it comes to securing a line of credit, and what tips do you give for people if they do get in trouble as far as in getting a line of credit?
Yeah, that's a very good question. So in my 22 years of banking experience, I think Michael alluded to this earlier. So a line of credit should be solely used for business purposes, right? It's not to go buy, a boat or go to, Las Vegas and things of that nature. So you have to have that self-control, and you want to ensure that you're using that line of credit very similar to a credit card, that you're only using it for business purposes, whether again it's marketing, payroll, just any normal day-to-day operating expenses. Again, it's not for a long-term purchase. I wouldn't advise buying an expensive piece of equipment on it, or again buying personal assets, things of that nature. So essentially what happens is if you do overextend and you don't pay down what we call the cooling period on a line of credit, banks typically will term out that line of credit. You won't have access to that working capital any longer. So it'll go from a traditional business line of credit to a term loan, right? So that's something that you definitely don't want to do. You want to make sure that you're revolving the line of credit, right? It's cycling. You're paying more, because essentially you're only responsible for interest only every month, but you always want to make sure that throughout the year you are paying down the principal as well.
And then how do you evaluate when to increase, and when should businesses consider increasing an existing line of credit?
So the way we look at it is, obviously that there's an opportunity for the business to grow. We look at the collateral. So as long as the debt service coverage ratio, which is 1.25, when we look at that, they're able to support it. The collateral aligns with their request. At that point, we have no problem increasing the line of credit, as long as it's justifiable and it makes sense. Because the last thing we want to do is extend a line of credit to a business not able to afford it from a standpoint of supporting, taking on more debt, and what's the form of repayment, right? So that's how we typically look at it.
And then if anyone has any questions, you're welcome to put them in the chat, and then I'll read them, and then read them for our panelists to answer any questions you may have for anything that we didn't cover. And then can you let us know where, so I guess I'll start off with Richard. Where can we, so if someone wants to come in and talk to you, well, where's your office located?
I'm located at 2929 Navigation Boulevard, Houston, and zip 7003. I can give my cell phone number. You guys are ready. So cell is 832-816-6460. And then my office is 281-517-4320. And you guys are more than welcome to call me for any questions or anything that that comes to mind, around business lending. Please don't hesitate to give me a call.
And then for Michael.
I'm located downtown. My office is the Chase Building, 712 Main, which is kind of our flagship branch for Chase in Houston. And my number is 281-804-3321, which is my cell phone, or my landline, 713-752-8904. That currently routes to my cell phone anyway, so both end up at the same spot. To go back a little bit more to your prior question, Alvin, is one of the things we look at from a line of increasing lines of credit. We establish lines of credit, as Richard said, on collateral as well as cash flow. The other part that we look at is the revenue number. So if your business is generating $500,000 in sales through the year, it doesn't make sense to us to set up a $500,000 line of credit. So we establish the line of credit as a percentage of the revenue subject to cash flow and collateral. So we look at generally about 10 to 25% as a range for a line of credit. If you're a $500,000 company, a line between 50 to or 1.25, depending on the other factors, would be the way we look at it. So as your business grows, then you might want to continue to come back to the bank and say, look, I've grown from $1 million company to a $2 million company. My needs are higher, so let's talk about increasing that line of credit.
And then, so, I mean, particularly in the legal field, like and I think for a lot of attorneys who work in the personal injury world, and you have years where you have a big case and you could have $2 million in revenue, you could have a year where it's 500,000 or less. I'm just pulling out those numbers. So do you guys reevaluate every year whenever you're looking at a business to decide if you're going to decrease someone's line of credit if you're seeing that their revenue is going in the opposite direction?
So it depends on the line size. So the lines that we have up to $500,000, they're set for 5 years. So if you don't come back to us to increase it, they'll stay the same. We don't require updated financials. If your line is higher than that, then we look at it on an annual basis and renew the line on an annual basis. So it depends on the line size. And obviously we want to understand the story, and that is my job, is to package the information together, understanding what's going on behind the company, making sure we're comfortable with establishing a line based on what is actually happening with the company, just on not based off a 1 year lull or home run.
Yeah, and with us here at Allegiance Bank, that's a good question, Alvin. We do, every year we do reevaluate. I mean, you got to provide our lines of credits that are not secured by real estate. They're only good for 1 year. So at that 1 year mark, when it's time for renewal, we definitely take all those factors into consideration. Obviously your revenue, net operating income, things of that nature. So we do have to underwrite that line of credit every year. Now, if there's real estate that's involved, those are a little different, and those are actually a 2-year term for anything that's got real estate pledged as collateral.
And I just want to clarify, because you both mentioned this. So regardless of whether it's a commercial bank or a community bank, the amount that any small business borrows should be an amount that can be repaid within 12 months. Because I know for community banks, it's reevaluated every 12 months, but it sounds like from a commercial bank, if you're approved, unless it hits a certain amount, you're not evaluated every year.
So right. I'll take that we don't, I worked at a regional bank prior to coming here at Comerica. They had evergreen lines very similar to Chase, to where, I mean, those were, I think they've scaled it back now to 5 years. They had 10-year lines of credit. So as long as you're not overextended. Now, let's say what I did see when I was there is clients would get in a bind where, and I mentioned this earlier, where they're drawing off that line of credit and they're only paying interest every month. They're not paying anything to the principal. Then that's when they're going to term it out. So here we do look at it on a year-by-year basis, and we do that for that reason, obviously, to make sure that the business is healthy and it's it's not deteriorating, it's not trending downwards. We want to make sure that we get a handle on that. So that's how it works here. We do put them on a borrowing base if they got account receivables and or inventory. That's how typically how Now, anything under less than 150,000, we don't put them on a borrowing base. If it's 150 or more, there's other financial requirements reporting that's needed, actually on a monthly or quarterly basis. So.
And then for the, I'm sorry, but so for Richard, what is the minimum that a small business could apply for a line of credit?
For us, I mean, essentially, I mean, anything really anywhere from 10 to 25,000. I mean, we may look at doing something unsecured. So minimum would probably be 10,000, and then obviously we can go up to, 10 million. So, 10,000 just to get started is the minimum that we'll consider looking at putting in place for a business owner.
Okay, and that's for a business owner that's been in business for at least 3 years.
Correct.
Okay.
Now, if they got other collateral to pledge, then obviously, I mean that we're going to look at, our rule of thumb typically is 20% of the revenue. So depending, that's kind of a guide that we'll use, 20 to 25%. It's just a guide, right? So we'll look at that. We'll look at what they've got to pledge as collateral, and then we'll run what we call the debt service coverage ratio, and we'll see what we can come up with to be able to meet their needs.
And then I see you, Michael, you're shaking your head. Is that something that you agree with as well?
Yeah, very similar to ours. So yeah, so I think, I'm not sure what the exact minimum, it may be somewhere in the 10 to $25 million, 25,000 range. If it is smaller, obviously Chase credit card is an easier solution, faster. And then we go up from there based on the need of the company. And so ours are very similar to what Richard said.
And then I guess just my last question is there anything that you want to share with young attorneys that they should be thinking about before they just any general advice as far as in building up their credit so that they can get to that point where they can get a line of credit from a community bank or from a commercial bank?
I'll share what I mean, I can talk about this for a long time, so I'll keep it short. Like both Richard and I have years of banking experience. So any new business needs to be handled with as a priority. The best businesses that I've seen are people that are able to balance their strength. So as attorneys, your strength is to do your work as an attorney with his cases or providing solutions, documents, whatever your field is. That's your strength. You are able to generate that income, but at the same time, you have to balance that with running a company and your financials. So one of the things that's important, obviously your personal credit is very important, as equal as your financials, quality of financials. Running a good company and focusing on running that business is important to us because we look at the business first, right? We want to we manage risks, so our lending is based on the comfort that we have based on that risk of that business. If it is not being run properly, as let's say Richard requires quarterly financials, and if you're not able to produce them in a timely fashion, what is the problem with the company? Are you not able to manage it properly? So that's something that that would be needed. So I would encourage any business owner to spend time in your week working on the business, whether it is managing personnel, managing financials. Obviously, we look at attorneys as something that we encourage other clients to have a good attorney, and obviously have a good banker, have a good attorney, have a good insurance agent, and a good CPA. So those are the 4 things. So having a good banker, so have a good CPA, have a good insurance agent. Obviously, we will provide the banking part of it.
Okay, well, those are my questions that I have for you guys for this panel. Unless you have any other information that you want to give to our listeners, thank you so much for your time.
Thanks for having me.
Glad to be on, and thanks for the opportunity to speak to everybody.
All right. Well, thank you all for attending. Again, the CLE credit information is in the chat. It's 174-127274, and we will be having our event. We'll have another presentation next month, and that will talk about commercial leasing. So thank you again for your time, and talk to you all soon.
All right.